Okay, let's try and unpack this. Imagine billions of dollars in crypto contracts, all coming due on like a single day. What happens next? That's exactly what we're diving into today. Deribit's massive crypto options expiry.
Yeah, it's fascinating how these huge financial events, they often seem so complex, but they actually act as these really crucial pressure release valves for the market, for volatility.
Right, they're not just numbers on a screen.
Not at all. They're moments of truth for, well, countless financial bets.
Absolutely. And we're drawing our insights today from a pretty detailed A-Invest report that's focused right on this looming event. So our mission really is to cut through the jargon, cut through the noise, and understand why this specific expiry, August 22, 2025, is so significant. I mean, we're talking $4.8 billion in Bitcoin and Ethereum contracts. It seems like it's setting the stage for some, well, potentially dramatic market moves. Our goal is to equip you, listening, with a clearer understanding of the forces really at play here. So here's where it gets really interesting, the scale of this thing. When we say scale, we're not exaggerating, are we? It's $4.8 billion. That's billion with a B.
It's a staggering number.
Worth of Bitcoin, BTC, and Ethereum ETH contracts,
Yeah.
all set to expire on the Deribit platform.
Yeah, and it's not just the number itself, it's the concentration. All that financial leverage, all culminating on one specific date.
August 22, 2025. It demands attention.
It really does. And maybe we should quickly clarify options expiry for anyone who's less familiar.
Good idea.
Okay, so basically an option gives the holder the right, and this is important, but not the obligation, to either buy or sell an asset, right? In this case, we're talking Bitcoin or Ethereum. And they agree on a price beforehand, the strike price, and there's a deadline, the expiry date.
Right, so when that date hits.
Exactly. When they expire, it forces a decision. Do you exercise the option because it's profitable? Do you sell it to someone else? Or if it's worthless, you just let it lapse.
And with BTC and ETH, these aren't minor assets, they're heavyweights.
Precisely. Two of the market's biggest players. So when you have this volume, this $4.8 billion worth expiring at once, it creates this significant moment of truth. You're essentially liquidating a huge volume of market bets simultaneously.
Sort of mass settlement.
It's a good way to put it. And that settlement process itself, that generates market movement. The sheer scale for these two specific cryptos makes this expiry particularly impactful.
So, okay, the big question then. Looking at this A-Invest report, what does this all mean for the broader crypto market as we head towards August 22nd? Are we talking about like a guaranteed roller coaster ride here?
Well, guaranteed is always a strong word in markets, isn't it?
True.
But look, this isn't just another expiry date on the calendar. I mean, options expire all the time, weekly, monthly. But very few combine this kind of magnitude, this sheer size, with the specific market dynamics we seem to be seeing right now.
So it's the combination that's key.
It's the convergence, yeah. It sets the stage for potentially some genuine price discovery.
Yeah.
Real market shifts, not just, routine fluctuations. It's a moment where all those individual bets, all that positioning built up over time, it all comes to a head. And that forces reactions, adjustments right across the market.
Okay, so the A-Invest report, it really seems to zero in on three key elements, three drivers behind these potential dramatic moves. It's not just one thing, but like you said, a confluence. Let's dig into the first one they mentioned, the collective positioning from traders. What does that actually entail?
Right. So this isn't just about one trader buying a call or another selling a put. It's about the sum total of all those bets. It's essentially the market's collective forecast, or maybe it's collective wager, on where BTC and ETH prices are headed.
So how many people are betting prices go up versus down?
Exactly. You have call options for those anticipating a rise, put options for those betting on a fall. Each contract is a decision, a forecast, a financial stake. Now, as that August 22nd deadline gets closer, all these individual positions piled up together create this immense pressure, sometimes quite intense pressure.
Because everyone has to decide what to do.
Precisely. Do I close out my position now, maybe take a smaller profit or loss? Do I exercise my option if it's in the money? Or do I just let it expire worthless? This mass decision-making happening all around the same time creates direct buying and selling pressure right there in the spot market.
The market for actual Bitcoin and Ethereum?
Yes, it acts almost like a massive forced rebalancing event. and that can significantly move the actual price.
Got it. So it's not just the bets existing, it's the unwinding of those bets as expiry looms that really drives the potential volatility.
That's it. That collective unwinding. That's a major engine here.
Okay, building on that idea of collective bets and sentiment, the report also flags something called skewed put-call ratios.
Mm.
Now, for those of us tracking these markets, what exactly does a skewed ratio tell us, and why is that so important for potential volatility?
Right. This is a really critical concept for gauging market mood. So, as we said, a call option is the right to buy essentially a bullish bet. Right?
Price goes up.
And a put option is the right to sell a bearish bet, price goes down. The put-call ratio is, well, it's pretty straightforward. It's the total number of outstanding put options divided by the total number of outstanding call options.
Okay, simple division.
Simple division, but powerful insight. A skewed ratio just means there's a big imbalance. For example, if there are way more puts open than calls, the ratio is high. It's skewed towards puts.
Meaning the market is feeling pretty negative or bearish.
Exactly. It reveals a predominantly bearish sentiment. Lots of people are hedging or betting on a downturn. Conversely, if calls dominate, the ratio is low, skewed towards calls, suggesting bullishness.
So why does the skew matter so much at expiry?
Well, think about it. If you have this strong pre-existing imbalance in sentiment, this heavy skew, and then expiry arrives. If that sentiment gets confirmed, like if the market actually does fall sharply when there's a huge put skew, then the rush to act can be dramatic.
Everyone tries to cash in their puts or maybe buy protection.
Or sell the underlying asset to cover their positions, yeah. Everyone rushing for the same door at the same time intensifies the initial price move. It pours fuel on the fire, basically.
Causes those big swings.
Significant price swings, potentially. It's a really powerful gauge of the market's collective fear or greed. And when that psychology turns into mass action around expiry, it can really move the needle aggressively.
Okay, that makes sense. A strong indicator of market psychology. But there's a third factor the report mentions, something a bit newer, the recent rollout of USDC-settled options. How does settling in a stablecoin USDC add another layer here, another layer of complexity or maybe unpredictability to this expiry?
Yeah, this is an interesting development. It's not just a minor technical change. It potentially alters the kind of capital flowing into these options and maybe how that capital impacts the spot market afterwards.
So USDC, that's the stablecoin pegged to the US dollar, right?
Correct. Pegged one-to-one with the US dollar. Now, many traditional crypto options, they settle directly in Bitcoin or Ethereum. If your call option is profitable, you might receive BTC, for instance.
All right.
But with USDC settled options, the payout, the profit or loss, is calculated and delivered in USDC, in that stable dollar equivalent value, not in the volatile crypto itself.
Why does that matter?
Well, it could attract a different crowd. Perhaps traders who want exposure to Bitcoin or Ethereum price movements, but maybe they're less comfortable holding the actual volatile crypto asset itself. Or perhaps institutions with different mandates.
So it could broaden the pool of participants.
It could expand the participant pool, which is definitely noteworthy. And think about the settlement itself. Even though the payout isn't directly in BTC or ETH, that resulting USDC liquidity, those stablecoin profits, can still be redeployed back into the spot market very quickly.
Ah, okay. So if traders get paid out in USDC, they might immediately use that to buy more Bitcoin or Ethereum if they're bullish, or maybe sell existing holdings if they took profits on puts.
Precisely. It changes the path that the capital takes after settlement. It might introduce new, maybe less predictable, ripple effects on expiry day, because the flow of capital is different, and the types of players involved might react differently.
So it signifies an evolution in the market's plumbing, essentially.
Yeah, an evolution in the market infrastructure. It's a sign the market is maturing, developing more sophisticated tools. But new mechanisms often bring new dynamics, new ways for capital flow and trader psychology to interact, especially during high-pressure events like a massive expiry.
Okay, right. So we've broken down these pretty intricate mechanics, the trader positioning, the put-call ratios, these USDC options. But let's bring it back to the listener. For someone maybe just holding some crypto or just trying to understand the space better, what's the real practical takeaway? Why should you care about these billions and ratios and stablecoin settlements beyond just, finding it intellectually interesting?
That's a really important question, actually, because understanding these underlying dynamics, it helps you move beyond just seeing what happened in the market. Price went up, price went down, to actually grasping why.
Seeing the machinery behind the curtain.
Exactly. When you read a headline about a sudden market surge or maybe a sharp drop around a certain date, knowing about Things like massive options expiries, knowing about trader positioning, understanding the sentiment revealed by put-call ratios, the nuances of settlement. It allows you to connect the dots much more effectively. You start to appreciate that these big market movements often aren't random. They're frequently the result of these huge, concentrated financial events and the structural mechanics of the market itself.
So it's about context.
It's about context, and it's about a deeper appreciation for the complex interplay between financial instruments, human psychology, that fear and greed we talked about, and the actual market infrastructure. All that shapes the world of digital assets and, frankly, all financial markets.
Makes sense.
So knowing about these factors means you're not just informed about the price today. You're, let's say, well-informed about the potential for shifts tomorrow. You can interpret news more critically, maybe recognize potential causes for volatility before they hit the mainstream headlines. It just gives you a richer, more nuanced understanding of how these powerful financial ecosystems actually work. It empowers you to understand the why behind the what.
That's a very powerful way to frame it. Okay, so let's quickly recap this deep dive then. We've explored this massive $4.8 billion Deribit options expiry for Bitcoin and Ethereum, locked in for August 22, 2025. It's looking like a potential fulcrum for, well, dramatic market moves, and it seems to be driven by really three key factors highlighted in the A-Invest report. First, that immense pressure coming from the collective trader positioning.
Right, all those bets coming due.
Second, the insights we can get from skewed put-call ratios about the overall market sentiment, bearish or bullish.
The market's mood ring, essentially.
Yeah. And third, those evolving dynamics introduced by the newer USDC settled options, changing how capital might flow.
Exactly. And what's really fascinating, I think, is the synergy. How these distinct elements, from individual trader bets to the broad market sentiment they create, right down to the plumbing, the infrastructure settlement, how they all converge. They come together to create an event with such significant potential for dramatic market shifts. It really offers us a glimpse, a kind of masterclass, into the sophisticated mechanics of crypto derivatives and how they can ripple through the whole asset landscape.
A complex machine with lots of moving parts.
Very much so.
Okay, and as we wrap up this deep dive, maybe here's a thought for you, the listener, to carry forward. The next time you see headlines screaming about market volatility, whether it's crypto or, traditional markets, try looking beyond just the big numbers. Consider those hidden layers we talked about, the collective sentiment of countless traders, the specific types of contracts involved, the evolving ways those contracts are settled. What other market events, big or small, might be subtly shaped by these often overlooked underlying forces? It's worth keeping those deeper questions in mind.